I'm Sarah Williamson, and this is Going Long with FCLT Global. On this show, you'll learn what it means to be long-term from the top minds in global business and investing. Leaders from companies and investment organizations join us to discuss how they are leading their teams for the long run on issues including capital allocation, risk management, climate change, and sustainability. To learn more, visit our website at fcltglobal.org. This is Sarah Williamson. Thank you for joining us at FCLT Global's podcast, Going Long. Today, our guest is Mark Machin, the President and CEO of CPP Investments. He's been in this role since June of 2016, where he's responsible for leading CPP Investments and all of its investment activities. CPP Investments has a unique public purpose to help provide a foundation upon which 20 million Canadians build their financial security in retirement. CPP Investments manages over $450 billion in assets under management, which is invested around the globe. Mark joined the fund in 2012 as its first president for Asia. Prior to joining CPP Investments, Mark had a 20-year career at Goldman Sachs. Mark has also been the chair of the FCLT Global Board since January 2020, and CPP Investments was a founding member of FCLT Global. So Mark, thank you so much for joining us for this podcast today.
It's a huge pleasure. Great to be here.
So maybe we can start with the basics, which is many people are familiar with the Canadian model, but not everybody. So could you describe a little bit about the Canadian model for retirement savings and CPP in particular, both your purpose and your time frame?
For sure. So our fund, the CPP, is a mandatory fund. So everybody in Canada who works has to pay into the fund. Everybody in Canada outside of Quebec. And so we have about 20 million people who work, pay in, or retirees and are beneficiaries from the fund. So you pay in somewhere just over 10% of your earnings into the fund, and when you retire, you get a payout from the fund for the rest of your life, depending on the amount of your income when you were working. So that's the fund. Now, our job, CPP Investments, was set up 20 years ago as a completely independent, arm's length, free of all political interference company with the sole purpose to manage the money that is not immediately needed to pay benefits. So that's how we were set up 20 years ago. And we were given a very, very simple purpose, which is to maximize returns on the funds without undue risk of loss. Now, I say simple. It is simple. It's terrific that it's simple and clear, but any people who are listening who are in the funds management or the finance world, which I suspect most people are, know that maximizing returns without undue risk of loss is far from simple in practice. But in any event, that's how we're set up. And so we have grown over the last 20 years from when we first took on the first dollars of money to today having somewhere around $460 billion of assets under management. We invest around the world. We invest across public markets, across private markets, real assets. And we have 9 offices. We have approaching about 2,000 people. And we manage the money in this broadly diversified portfolio in order to achieve that objective of maximizing returns without undue risk. Now, the final thing I say, and why we're so interested in long-term and FCLT Global, and why we're so attached to the organization is because long-term is in our DNA. It is exactly what we're asked to do, because ultimately we are growing this pool of capital for people's retirements over many generations. So we have a pool of money that people have to contribute to. It's a very predictable pool of money. It's a pool of money that people can't take their money out of other than when they retire. And that comes out in a very predictable way. So it is a very stable and inherently very long-term pool of capital with a goal of building these savings into retirement security over many, many, many years. So long-term is in our DNA, in our blood.
So that makes perfect sense given your time frame and your liabilities. But how have you actually baked that in, the long-term mindset into what you do? Because of course there are many pension plans around the world that also have long-term liabilities. Perhaps they have different structures than yours, of course, but that struggle with this tension between short-term and long-term. And while there may be long-term goals, the short-term tensions sometimes overwhelm them. So can you give us a couple examples of some of the steps that you all have taken to actually bake in that long-term mindset across those almost 2,000 people and all those activities around the world?
Yeah, for sure. And so first of all, we do have a little bit of a structural advantage over many pension funds here in the world. And that is that we have more money coming in from our contributors than we have to pay out to our beneficiaries for many years to come. And that comes out of a long-term issue in that the fund itself was set up in the 1960s. It was set up as a pay-as-you-go fund. It was set up based on demographic projections in the 1960s, which changed quite profoundly. And to cut a very long story short, it basically was heading into crisis and running out of money in the 1990s. So it was completely restructured in the 1990s. It was put on a sound footing. And part of that sound footing is there are more contributions coming in than benefits being paid for many years. And then we were created to manage the money at arm's length from all politics. So that comes on to the second thing, which is a lot of funds have the challenge of short-term redemptions, which we don't have. A lot of funds have the challenge of when markets turn down, people need to reach into the fund and take money out for government purposes or reserve purposes or other requirements. We don't have that. So we are blessed with a number of very strong structural advantages. That said, we've also really worked hard to encourage our teams to have a long-term mindset. So we really take advantage of that. So we're not traders. We don't try and compete in a short-term trading space, a high-frequency space or short-term trading space. We try and compete in that long-term space where we believe we have that structural advantage, and we pay our people based on long-term performance, not short-term performance. So it's structural, it's systematic, and it even goes down to compensation.
And as you think about the long term in the current environment, clearly we've had a lot of volatility this year given COVID, but the markets are very strong right now. How do you think about riding through something like the uncertainty and volatility that we've seen? How do you both take advantage of those sorts of things and keep that long-term perspective? How do you think about doing both of those at once?
Yeah, so I think a couple of things. But one is that we have to make sure that we have sufficient liquidity, sufficient reserves, sufficiently strong reserves to comply with any requirements that we may have in the shorter term for our portfolio companies, for liabilities that we have, or even in a very unexpected case which happened in the last 12 months, where we actually, with this incredible spike in unemployment, almost looked at having a net outflow from the fund. And that was, I say we almost had that, but it's not actually happened. So the first thing is to make sure that we have those sufficient conservative reserves in place. Second, then, is to make sure we also have the capabilities to move quickly on opportunities in markets where we see significant disruption and significant value opportunities, which again we did to a decent degree back in April, May. I mean, in hindsight, of course, everybody, certainly we, and many of the funds we invested in wish they'd invested more back then, but we did seize a bunch of opportunities across different markets back then. The third thing is, which I'm sure we're going to talk about more, is maintaining that long-term perspective and making sure that we're not caught up in over-focused in recency. Whatever's currently buffeting us, you think is going to go on, or you over-anchor on that, but making sure that we do keep an eye on and really heed the long-term trends and where the long-term value creation could be. And we do believe in a lot of cases in mean reversion. And so, we think, for example, through COVID, there's a bunch of industries that are really suffering right now. There's a bunch of hospitality-based industries that are suffering right now. But I think, to take an extreme example, I mean, I think generally, I think it'd be unlikely that we're not going to go back to eating in restaurants. So behavior is going to change for quite a while here. Restaurant businesses may struggle, but I think that whole hospitality industry, certainly hotels, for example, not the ones that are able to weather this are going to come back over time. The cruise industry and the cruise lines is another area where we think some of the strong will survive here, and they are likely to come back over time. So we're trying to take some contrarian positions in the hospitality industry, in cruise lines, and hopefully they turn out to have been good bets, and we see somewhat a mean reversion of behavior, and certainly the stronger companies here we think will do well in the long term.
I know you've spent a lot of your career in Asia, and obviously the response in some countries in Asia has been different than in countries in the West to COVID, and the economies are behaving differently as well. So how do you think about the diversification across countries, particularly in this kind of, particularly in this kind of environment, and also in the long term? How do you think about investing in the long term in Asia versus other parts of the world?
Yeah, so long term, I think we believe that Asia is going to continue to grow and become a more important part of the world. And that's certainly been the case for the last 20, 30 years. So whatever metric you look at it from, percentage of global GDP, percentage of global market capitalization, percentage of global trade, and it comes back to percentage of people. If you look at Asia Pacific, reasonably defined as 60% of the world's population, whereas North America is just over 4%, or around 4% of the world's population. So is GDP per capita, or is income, it converges towards developed market levels in a number of markets, then clearly Asia is going to continue to emerge as the leading region of the world. So that trend has been, not necessarily linear. It's been bumpy, and will probably continue to be bumpy. But it seems likely to continue, and therefore we should continue to grow our presence in Asia Pacific. So today, about 30% of the fund is invested in Asia Pacific, and that's likely to grow over time. The way that COVID's been handled, I mean, I think there are some idiosyncrasies depending on the type of government that you have, or even not necessarily even type of government, but the nature of your country. Whether you're an island nation, an island country as well, it's easier to manage, easier to close borders and to police those borders. And so some of those countries have done exceptionally well in controlling this. For New Zealand, Australia, Taiwan, China. but more, larger, more complicated countries, other than China, have struggled with the management of COVID. So clearly, this has given a little bit of a boost on a relative basis to some parts of Asia. But I think the longer term trend is the more important one.
So another long-term trend that we see that I know you all have been involved in is thinking about gender equity and diversity in markets. Clearly, the road to both gender and racial equity may be a bit bumpy, but hopefully the direction of travel is clear. And I know that CPP has been a leader in thinking about how corporate leaders can identify and attract diverse candidates. Can you talk about sort of your perspective on the role that you have as a large shareholder in encouraging companies that you invest in to be more diverse, how you see that and how you see that playing out over the next few years?
Yeah, for sure. And this is an area that we can talk a lot about. It's one where I think the good news is there's a lot of momentum for change here, and that is that's excellent. So we ultimately want to create long-term value, long-term risk-adjusted returns, and we think there's more than sufficient evidence to show that. And FCLT Global's done this work as well. There's more than sufficient evidence to show that long-term risk-adjusted returns are correlated with diversity on boards, diversity of senior management. We ourselves did a meta-analysis of about 100 external research reports. We also did our own analysis of several thousand securities, looking at long-term value creation and controlled for all sorts of other aspects that could have led to that, whether it's industry sector or type of company, growth versus value, or all these other factors. We controlled for all these factors and then looks at diversity alone, isolating that alone, and it looked really compelling to us that it is correlated with long-term value creation. So plenty of quantitative analysis proving that. And then in practice, I think it's quite clear why, in that it leads to more robust decision-making, better decision-making, more diversity of thought, more challenge. Now, diversity is hard. It's a little harder than assembling a bunch of people who are of same gender, same group, same mindset. But that can lead to the perils of groupthink and also a little bit of lazy thinking as well. So I think if you work hard, if you create this diverse environment, you can get much better outcomes. We see it in our own organization. We've seen it in so many other organizations. So with that in mind, we're not doing this to change the world. As one of my fellow board members in FCLT Global has said, the discussion here has gone from values to value. And it's about risk-adjusted returns for us. So we push for this in the public companies that we invest in. We push for it on the private companies that we invest in, and we push for it on the funds that we invest in. So direct and indirect investing, we push in a whole bunch of ways to increase the dimensions of diversity and diversity on boards. And we started off with public companies, and we started off in Canada, in particular on voting against boards that didn't have women on the board. We took that and extended that out globally a couple of years ago. We've increased the requirements in Canada to 2 board directors, and we continue to increase this across. We'll continue to increase this probably across the world, and we continue to push this on the private side as well. On the private side, by some metrics, there's 3 times the number of boards, just for example, in the US versus public companies. There's a lot of work to do in private companies.
And that leads to this whole discussion of stakeholder capitalism. So there's, there are varying definitions of stakeholder capitalism, but there's a lot of discussion about the idea that capitalism is really meant to benefit all of the stakeholders rather than simply the short-term shareholder. You, of course, are a long-term shareholder. So how do you think about, as a long-term shareholder, how do you think about stakeholder capitalism and its effect on your returns as probably one of the longest term shareholders that are out there?
Yeah, well, I'd say, ultimately we do, our fund and our pensioners do depend on the financial returns. So ultimately that is important. But I'd say there's not a lot of misalignment here, certainly when it comes to ESG. So I'll start off with ESG, environmental, social governance concerns. There's not a lot of misalignment between ESG and good risk-adjusted long-term returns. I mean, and some of this is sort of obvious or maybe simplistic from a distance. I mean, companies that in the short term trash their environment are going to end up with a lot of fines, a lot of regulatory issues, a lot of risk, a lot of health issues, legal issues. And so, thinking about long-term environmental degradation is probably aligned with a lot of companies' long-term returns. Similarly, with social issues, I mean, companies that abuse labor, companies that don't engage with their local communities are going to end up with similar problems with the environments and the communities that they live in, and also with their customers. Customers' behavior. Customers are not going to like these companies, not going to want to engage with these companies, not want to buy their products. And likewise on the governance front, we talked a little bit about diversity, but again, poorly governed companies generally are not great bets in the long term. So all of these indicias are generally aligned with the long term. Now, what we tend to look for is those indicias that really matter to that particular industry or that particular company, and weight those importantly. So, for example, the water consumption of an asset manager, a publicly traded asset manager, is probably less relevant to us than the water consumption of a textile company. So how much the textile company thinks about water security, water consumption, clean water in the environment and communities around it. That probably matters a lot more to us than looking at how much a publicly traded asset management company in New York uses water. So it's things that are really relevant and things that are really relevant for the long-term viability of the companies. So when I think about stakeholder capitalism, some of this is common sense that you need to look after. If in the long term, it's common sense. It means you need to look after not just your shareholder, but your customers, your employees, your community, and then think about the environment and these social and governance obligations.
And as we think about the environment or climate in particular, clearly as a long-term investor, climate is both a risk and an opportunity for you. So, climate is a risk in terms of assets you might own or real changes in, patterns of weather or migration. But it's also an opportunity in that it looks like as we transition to a greener economy, there will be a need for significant amounts of capital to retool and transition. So how are you thinking about kind of the risks and the opportunities of investing with a climate lens, and how do you expect that to change over the next few years?
Yeah, I mean, this is a massive issue. It's one that we've been working on for the last 11 years or so, and is the big issue of our time. And the good news here is, at the time we're doing this podcast, the US is back in the Paris Agreement, and we are rapidly heading towards COP26 and the hopefully even more momentum in the world to tackle this. But this is, I think this is somewhere where there's momentum, but there needs to be a lot more momentum. I mean, I think some of the biggest moves have been companies announcing when they want to go carbon neutral, countries announcing companies, and now countries announcing that as well. And I think that's going to really accelerate a lot of activity here. The more countries that set those goalposts, the more companies are going to have to move to meet those carbon neutral dates. I mean, someone said the best news of last year was China's announcement of carbon neutral, which, yeah, is 2060, but doing some back of the envelope calculation, they calculated that's probably going to reduce the world's temperature by that time by about 0.3 degrees. So that's someone said that's probably the best news of last year. There's a huge amount that's going to go on here. From our point of view, again, we look at it through this risk-return lens, and there are multifaceted risks that we need to understand. There are risks when we invest every major investment we make, we put through a climate change lens, and we have to think about things like what will be the physical and geographical changes that could happen that are caused by climate change. What are the regulatory changes that are inspired by climate change that could impact the company? What are the consumer behavior changes that could impact the company? So, for example, we recently invested in a toll road in Indonesia. It's going to be a long-term investment. We expect to hold it over many decades. And one of the most important risks to that investment is, even though it's just a road between two cities, one of the most important risks is climate change, and what's that going to do to flooding patterns? What's that going to do to maintenance costs? What's that going to do to traffic patterns on the island? So these things are really important for us from a bottoms-up perspective for each investment that we make, and also from a top-down perspective, we're trying to be thoughtful about how we construct the portfolio overall, and take climate risk into account as well from a top-down perspective.
So, as I'm sure you know, in the U.S., the Department of Labor had a ruling a few months ago that has been discouraging investors from considering climate change. It sounds like what you're saying is it's pretty hard or perhaps even imprudent to make a long-term investment like the investment in the toll road that you mentioned without considering climate change. How do you sort of square those two?
I can't really comment on that ruling, but I definitely agree with your follow-on statement. So I definitely agree that it would be imprudent to make a long-term investment without considering climate change. Now, in some cases, maybe in a bunch of cases, it's not going to matter that much. But I think you need to really think about it for every investment, and you need to think quite carefully, because it may not be obvious. It may not be immediately obvious that you are running a bunch of climate risk by taking on that investment. There's going to be so much change here over the next decade, and there needs to be a huge amount of change. I think part of your previous question was, how do we think about this amount of capital that's needed to invest to catalyze this change? We obviously think this is a fantastic opportunity, and we want to catalyze this optimal transition, moving as fast as we possibly can to a low carbon economy, and doing that with the minimal hit to output GDP and the profitability of companies. And I think we're moving rapidly towards those types of solutions, but there's going to be lots of innovation. Innovation has to be part of the solution. I think Bill Gates has articulated this many times, that innovation has to be part of the solution here. So there's a lot of basic investment that needs to be done. There's a lot of huge amount of renewable power investment that needs to be done, and we're big investors in that in North America, in Europe, in Asia, South America. And there's also a lot of innovation that's going to be required, and long-term capital is going to be a critical part of that, whether it's in carbon capture, whether it's in hydrogen, whether it's in deep geothermal, some of these areas where, or battery technologies and that type of technology innovation that's going to be required here to create the whole solution and get us as fast as possible to that zero carbon world.
Yeah, and all of those things that you mentioned are things that require significant amounts of capital. They're not, an app on your phone or something. They need real money. So it's a huge opportunity. Coming back to FCLT Global, you're the chair of the board. CPP's been involved since the very beginning. As we look forward, we're thinking about these issues of climate and climate investing in particular, or how to move large amounts of money to climate solutions. We're thinking a lot about governance and diversity. We're thinking a lot about stakeholder capitalism in practice. And we've thought a lot about metrics. How do you, as we're evaluating new risks and thinking about companies in new ways, what are metrics that make sense for investors to think about some of these things? So can you talk a little bit about the issues that you see as being the most challenging in terms of this goal of rebalancing capital markets to support a long-term sustainable economy, and where you think there's a real opportunity for FCLT to make a difference?
Yeah, well, I think FCLT's made a real difference in the last 5 years since its existence in moving more and more people to thinking about long-term investing. I sometimes joke that we should have probably set up an institute on short-term investing to encourage more people to do that, and left the long-term space just for us to invest, because more and more people are really thinking this way. And we recently published the FCLT Compass to try and track that, how much of a difference we're making. It's one effort to do that, but the goal is to really move that mindset, because the more capital that is aligned ultimately with long-term value creation for savings, for people's lives, people's retirement, and then that money gets through to companies to build value in the long term, the better. It's going to create a lot more money. So in terms of metrics, there's a lot that's been going on. A lot of things we've been talking about on this podcast. I'd say we at CPP Investments really encourage companies to publish quantitative numbers on beyond the normal numbers. So when you get to ESG, really to publish numbers, publish real numerical targets, less adjectives, more numbers, and then we can work with those numbers. And we also been pushing for a standardization of numbers as well. So, for example, in ESG, we've been pushing for the SASB reporting methodology, the Sustainability Accounting Standards Board methodology. And for climate change, we've been pushing, along with our peers, the TCFD standard for climate-related financial disclosure. And I think that's getting more and more traction. And because that one of the challenges for companies, for investors, et cetera, is this alphabet soup of all the different metrics that are out there. And so I think FCLT Global has also been pushing this consolidation of reporting and moving towards more quantitative metrics of these types of sustainability measures.
I'm going to remember the less adjectives, more numbers, because I think that is a big part of this discussion about disclosure. Well, we've covered an awful lot of topics in this time, and as we look forward, are there any things that market trends we should anticipate? What's the next thing that's going to the next surprise that we don't know is coming? What are other things that you would suggest that investors or businesses think about? I mean, is it the next pandemic? Is it climate change? Is it political unrest? Is it maybe smoother sailing than we've had recently? So any words of wisdom as we try to look into the crystal ball of the future?
Yeah, we'll see how this podcast ages over the next several months. But I guess my while this is a long-term podcast and this is about FCLT Global, I'm going to make a shorter-term prediction that there's going to be, I think, a pickup in volatility over the next several months here, as I think we're seeing the move towards all clear and getting out of this pandemic. Unfortunately, it's going to be a bit of a bumpy ride. There's going to be bumps in terms of vaccine rollouts. There's going to be bumps in terms of mutations. There's going to be bumps in terms of the re-engineering of some of the vaccine. Hopefully, we don't have immune escape here, and it carries on for even longer than we're all anticipating right now. But it's going to be a bumpy ride. I think, though, the big issue, and it's terrific. We've got COP26 towards the end of this year. The big issue is climate change. That I think a lot of wise heads are focused on that as one of, if not the next big crisis. And it's terrific to see the world really coalesce around tangible action to address this, and having this terrific catalyst later this year, which is really going to catalyze activity this year in people setting more and more bold targets and really thinking about accelerating their actions towards reducing the amount of carbon in the atmosphere.
Yeah, it feels like there's a lot of momentum, and COP26 is a focal point of that. From FCLT's perspective, we are thinking hard about how do we use the capital markets to support that transition to a greener economy. How can the capital markets be supportive of the responses to climate change? And so that's going to be a big part of our agenda over the next few months, leading up to COP26. So with that, I think I'll say thank you, Mark. This has been quite the around the world tour de force of investing and thinking about long term. And obviously you have been such a leader in this area and such a driver for pushing long-term sustainable investing. And so we appreciate your leadership. We appreciate your time today. Thank you.
Well, thank you, Sarah. Huge pleasure.
Thanks for listening to today's episode of Going Long with FCLT Global. Be sure to hit subscribe to get new episodes every other Monday. To learn more, visit our website at fcltglobal.org.